My name's Jolon. I'm with Hyperion. Really good to see all of you out here today. A lot of familiar faces from our global summit that we did a month ago. There's a fair bit of repetition in this slide with Hyperion, as you'd expect, so lock the doors. You're not going anywhere. Hyperion's mission is really to grow our clients' capital sustainably over the long term, and we're really guided by that, by our missions, values and beliefs. You know, we're a hard-working, research-driven organisation. Our decision-making framework is evidence, merit and principles-based, and we're alpha-focused. We are acutely aware that Hyperion doesn't deserve to exist if we can't continue to generate long-term alpha for our investors. We see ourselves as long-term business owners. The two Australian products were officially unitised in 2002, and many of the stocks that we invested in back then are still in the portfolio today. We think long-term when we make all key decisions, staff, business and companies, and we're generalists who place the collective first, the collective being our investors who are ultimately your clients. The fund generation that we've had broadly comes from two main areas. 50% is roughly from market returns, and 33% of our net flows has come from the alpha that we've generated, the smallest portion being net flow from our clients. We're very proud of the track record of alpha generation that we've been able to produce, and hopefully we can continue doing it for the foreseeable future. Now, the great thing about being a little bit later down in the speaking set is a lot of the points that I'll argue have already effectively been made for me. We've heard today that growth is slowing, inflation is potentially peaking and rolling off, and I'll see if I can define that and really focus on how that's a really good thing for quality structural growth investing. Now, you've probably seen this chart before in various different iterations, but Hyperion for us obviously is growth investors. Having high returns on equity, earnings per share growth, and revenue growth is very important. But it's an observation for us that a lot of market participants will do this, especially in the growth sector, by potentially going early, speculating that a company will produce the results that they're trying to do, or they'll go into momentum plays. Whereas Hyperion, we won't speculate. We have a really high qualitative overlay and look for the really elite businesses that are able to generate returns, not just in years 1 or 2, but in 5, 7 and 10 years time. And so for us, growth that falls in our bucket is a very, very narrow view, and it really is just those elite 1% of businesses that we're investing in. And they generally have these qualities to them, what we call new world businesses. The disruptive technological strategies, they have sustainable competitive advantages, which is important because that produces that strong economic moat that protects future intrinsic values. Structural tailwinds, innovative culture, they're generally founder-led. And we like capital-light business models as well. We don't really like that much debt. And total addressable markets, really large total addressable markets. If you look back 10, 15 years ago, about 60% of the revenues that the companies that we owned came from domestic. Fast forward to today, about 85% is offshore. So you're actually getting exposure to absolute global market leaders that just happen to be listed here in Australia. And that lens really rolls into what we're avoiding. We don't own traditional banks, we don't own the miners, heavy industries, producers. A lot of these businesses are highly sensitive to the economic condition around them. We want absolute market leaders that are able to grow by taking market share, and that they're less sensitive to economic shocks. And we're also avoiding fads, early stage concepts and startups. Our process, pretty simple at the crux of it. We have a financial model, an intrinsic value in 10 years' time, and that'll produce an internal rate of return, what we're compounding it today to get to in 10 years' time. And then we have a high qualitative overlay, our research template, which produces a business quality score and gives us a lot of the insights into the risk adjustments that we need to build a portfolio. Very simplistically, the higher the IRR, the higher the weight in the portfolio, then you need to risk adjust that or right size that back in to build your portfolio. And that really comes down into 12 risk adjustments, including but not limiting to confidence in achieving that terminal value, short-term, long-term predictability of earnings, confidence in management, are they the right people to achieve that value in 10 years' time, business quality score, and long-term innovation. Are you going to continue to innovate, be better, so that your risk of competition is less? Thinking differently, there's two key inefficiencies that we look to exploit. The first one's really simple, it's time arbitrage. If you're able to identify companies that have that earnings per share growth, the return on capital, and they can do it not just years 1 or 2, but 5, 7 and 10 years time, you can produce what we call a beat the fade scenario, where that growth doesn't revert to the mean. That doesn't happen for the majority of growth companies, and again, you need to be extremely selective and have a high qualitative insight. The second of which is what we call the quality anomaly, and that's identifying businesses that are doing something completely different. They might be disrupting, reinvesting heavily, they probably may not be at scale yet, but if identified, these can be the things that really turbocharge your returns. A great example is realestate.com. We bought that in 2004 for 84 cents, and we still own it today. And we could see then that they were doing something really unique, something different, something innovating. Instead of spending 20 grand on an ad on one Saturday in the paper, you spend $1,000 and put that ad up online. And they're still innovating today. And we're also seeing some new entrants that fall into that field, whether it's Xero, WiseTech, or Pro Medicus. The estimates between us and the market vary a fair bit in the latter years. Markets are generally very efficient in the short term and overly efficient on the very short term. In years 1, the difference between our forecast and the market, you can see on the left-hand side. Sales growth, we're pretty much bang on. Year 2, almost the same. But in year 5, that pushes out to around 13 or 14%. But if we look to the far right, you can see the earnings per share growth. That's where it really gets interesting, is the earnings leverage of our companies is able to be shown through. So again, year 1, fairly efficient with markets around 5 to 6 or 7% ahead. But then the latter years in year 5 were anywhere from 25% to 35% ahead of market expectations. And what that means is that if we continue to be correct and our companies execute, you should get some earning upgrade cycles and then positive share price movement from there. The evidence of that can really be seen here. And you heard from Don today about the ASX 300 effectively going sideways for almost 20 years. The earnings per share growth of the ASX 300 has compounded at 4% per annum since 2002. And so what we're trying to do is invest in the ultra high quality businesses that are able to compound their earnings per share growth at much higher levels for much longer periods of time. The Australian Growth Fund's compounded it for around 10% per annum since 2002. And looking forward, we actually can see as these companies become more dominant and capture more market share and become more profitable, that earnings per share growth is running at around 17% per annum forecasted over the next 10 years. And that really is the positive jaws that opens up, which is the alpha that we've been able to generate for our investors. It's a fairly simple equation. The top line there is high sales growth with profitability, and the bottom line there is high sales growth with no profitability. Again, this is really just trying to illustrate that we're very selective in the companies that we want to invest in, and we want to see that earnings per share growth come through, not at the risk of no profits. Now we have 12 structural themes that diversify our portfolio and really deliver alpha. These are the structural themes or the tailwinds that are going to be the driving force of revenues and earnings in this decade and beyond. Some are really obvious, modernisation of banking, shift to AI-based platforms and cloud service platforms, and the traditional media into digital sides. And again, a lot of these businesses we've owned for over 10 years. But to give you a bit of an insight into where we're seeing some of the momentum that's coming through this year and the last 6 months, is what we've seen in the recovery in the healthcare names. And that's really been illustrated by the GLP-1 drugs, as you heard earlier, from Firetrail. ResMed, Fisher & Paykel were really caught up within that. And by just taking a longer term view, understanding the business, understanding the quality of the companies, we added to our positions through that time. And what you've seen is a reversion to mean to those valuations. And there's probably still a little bit more to happen there as well. The second of which is improved management across a number of our portfolio holdings, but you can really see a higher impact in a company like Block. We caught up with the founder, Jack Dorsey, in Melbourne, day after Melbourne Cup in Melbourne last year. The confidence in Block by meeting him, seeing him being back on the tools, raised significantly. And the share price has doubled essentially since Jack came back and started running the company again. Again, Xero, new management, February last year, really starting to see some cost control and better execution. And Domino's is a really interesting one. We think we've done the position weight well with Domino's, very low weight in the portfolio versus historically. We did the DD in Australia and Germany, and it looks like they've got that back on track. We're actually on site, the analysts are on site today in Japan, trying to figure out what's going on there, and we'll do further work on France. But the medium-term outlook for Domino's still looks okay, but again, that position weight won't improve until we see what's going on in Japan and in France. And there's further portfolio management opportunities to recycle capital around with our top and tailing approach of portfolio management. WiseTech's a great example. The stock's gone from $40 to $80 to $60 to $100, and we've been on the other side of that transaction to cycle capital. Altium, fairly bittersweet. It's currently in a takeover. It's great to see that our investment thesis has been proved, but a bit bitter because the 30-odd% premium is about 2% of 2 years of the returns we would have expected to see from Altium. The internal rate of return of our portfolio is still moderately above our long-term average of around, it's running at around 17% per annum forecasted over the next 10 years. Historically, it's been around 11 or 12%. So we still think there's a lot of positive momentum, forward momentum and value left in our portfolio versus that of our benchmark. And I'd like to leave you with a quote today. To be an investor, you need to believe in a better tomorrow. Investing isn't about what happened yesterday, today, tomorrow, or next week. It's about the future. And if you can identify high-quality businesses that are able to grow by taking market share, you should be able to accrue really strong returns like we have in the past. So, thank you.